Hey everyone, it's Griffin here, and in today's video we're going to be speaking about dividend investing, both through individual dividend stocks along with dividend-focused exchange-traded funds. About a year and a half ago, I came up with this concept called the Easy Portfolio on my channel, and the Easy Portfolio can be applied to a variety of different types of portfolios. For example, an easy dividend portfolio, an easy ETF portfolio, or even say an easy industry-focused type of portfolio. And the general concept here is to only focus on a handful of relevant positions to the type of portfolio that you're looking to construct. So in turn, this allows the investor to limit the amount of research necessary on each position, and then also the potential confusion that may arise when rebalancing the overall portfolio later on down the line. After all, for most retail investors, a more simplistic portfolio construction approach is going to be the way to go, because keeping track of, say, 25 individual positions on a consistent basis over time is difficult to do, especially if this is something that you do on the side, which for most of us is the case. And that's exactly why I love to make these easy portfolio videos, because I know the audience really values them, and for everyday investors such as ourselves, a more practical approach is always beneficial. When it comes to dividend investing more specifically though, I do tend to favor individual dividend stocks over say a dividend focused exchange traded fund, because I like to target companies that I believe in most for their distributions over time and the quality and sustainability of that dividend. But dividend ETFs can also be a good option depending on what you're looking for, so we're going to be covering both in today's video. So with that said, let's get right into it. But as always, if you're new to investing and you need to open up a brokerage account, make sure to check out the links down below to open up either a Wealthsimple trade account or a Questrade account, and you'll get free money for opening and funding your account. Okay, so generally when an investor is looking to create a portfolio focused on a portfolio income, the first thing that comes to mind is obviously dividend stocks, and that makes perfect sense. But where I see a lot of newer dividend investors go wrong is just trying to include way too many positions in their portfolio, which crowds it up entirely, and then also trying to only target companies that have the highest yield possible without doing a proper stress test for each one of the positions. Now, of course, every investor you speak to is going to have a different opinion on what the best strategy is and what best works for them. But for a newer investor specifically, I would tend to only hold, say, 5 to 7 individual dividend stocks. That to me is an adequate amount of dividend stocks that just makes sense for the average portfolio, because again, keeping track of 25 positions is overwhelming over the long term for the average investor. And granted that you did proper due diligence and research into each one of these 5 to 7 holdings, if they are solid companies that have quality distributions, then you don't need to spread out your capital across dozens of individual companies. Yes, diversifying your investments and investment classes is necessary over time, but 5 to 7 positions when you're first starting out your dividend portfolio is adequate, because you're going to be able to target top players in a couple of different industries. What is really important though when you are doing due diligence to determine which dividend stocks you want to include in your portfolio, I would follow loosely the following criteria. The first thing to look for is a dividend payout ratio in and around 60% or less. And pretty much what a dividend payout ratio is a relationship between the amount of dividends distributed over the course of a 1-year time frame by the company in relation to the net earnings for that given year. So for example, if a company is distributing 100%, they have a payout ratio of 100%, that means that all of their net earnings are going back to shareholders in the form of distributions. This doesn't really give them enough room for retained earnings to reinvest into the growth of their business. So anywhere between 60% or less, even 50 or less, is one of the criteria that I look for. The second thing that I like to see is a distribution history of at least 10 years. Now, this isn't 100% necessary, but basically what this is telling me is that the company is taking their distributions seriously, in that for a 10-year streak, they have been paying back distributions to shareholders. And that's something that I like to see, because it's going to give you a little bit more confidence that they're going to maintain and keep up that distribution over the course of time that you're holding the company. Following that 10-year dividend streak, another thing I look for is increases in the amount of dividend paid per year by at least 5% per year over that same 10-year period. This means that the company is not only paying out and consistently paying out their dividend, but they're also increasing it over time, which is something that you want to see as a dividend growth investor. The fourth thing that I look for in a quality dividend stock is increases in net income, and then also increases in cash flows, because these are the two values that are pretty much going to allow the company to well cover their dividend distributions, especially if they're increasing them over time. So just quickly looking at if the company is increasing both of these values year over year is something that I always look for. And finally, of course, is the company itself excelling and increasing their financials? Because this is also going to be beneficial, yes, for the dividend, but then also for capital growth over time in terms of appreciation of the share values. Because when dividend growth investing, you want a mixed balance between that dividend income and then also increased stock value over time. Of course, there are a ton of other factors that you can take into account when doing a global assessment of a quality dividend stock, but those are just some quick things to look over when doing an initial stress test. And always remember that when dividend growth investing, it's a nice balance between that dividend income and the capital appreciation over time. So if you're just going straight up for a 12% dividend yield stock without doing a proper and thorough analysis, well, you might quickly realize that that 12% dividend yield is bled out by capital loss over time. Basically, what I'm saying is a full assessment is necessary when determining which companies will be adequate for your portfolio. Okay, now quality dividend stocks can be found in a multitude of different industries, but here in Canada at least, the top dividend players tend to be included in the following industries, being banking, telecommunications, energy, utilities, as well as real estate. That's not to say that you can't find quality dividend stocks in other industries, but since these ones in particular tend to have high recurring income streams, they're able to more consistently distribute a portion of their net earnings back to shareholders in the form of distributions. For reference, this here is a list of all the Canadian dividend aristocrats, and you can clearly see that most of them will fall into one of these industries that I just mentioned. Now, I've made a bunch of videos over the years speaking about my top dividend stocks both in Canada and the United States. But when it comes to an easy dividend portfolio, you really can't go wrong with TD Bank, GoEasy, TELUS, Granite REIT, Fortis Incorporated, Capital Power, and Power Corp for that mixed balance between all of the criteria that we just spoke about. These stocks in particular have a great balance between dividend yield, dividend payout ratio, dividend increases over time, as well as capital appreciation. So with that said, an easy Canadian dividend portfolio could very well hold a nice mix of the companies that were just mentioned, and these have all been top players in their industries for years now. And by the way, none of those are necessarily stock picks or financial advice by any means. Those are just top dividend players that I've been able to identify over the years from my own research. On an equally weighted basis though, their yield would average out to a very nice 3.83%, and each one individually shows great promise for capital appreciation over time, along with dividend increases. So however you might choose to break up those positions or the ones that you choose to include in your portfolio after doing your own dividend stock research would be entirely up to you based on your investor profile and your desired asset allocation split based on what you're looking for as an investor. But those are definitely some great starting points for research into building a quality dividend portfolio. Considering the current macroeconomic environment, a lot of investors are now searching for safer investment alternatives in industries that are poised for growth over the next 5, 10, even 15 years. We've seen a fair share of capital rotation lately out of big tech and into other industries where investors can count on a more consistent return, including those dividend payments. And personally, while my paper asset portfolios mainly focus on a capital expansion strategy for now, meaning growth stocks over dividend stocks, well, I'm now focusing quite a bit more of my monthly contributions to my portfolios to the dividend players that we just spoke about, because I'm really looking to build out a portfolio that's able to throw off a couple thousands of dollars each in every year that are going to pay for some of my basic living expenses. This is, however, a long-term process and isn't something that you should strive to achieve in only a couple of years, because you'll quickly realize that at an average, say 3 to 5% dividend yield over your entire portfolio, you do need quite a bit of capital invested into these companies in order to throw off a substantial amount of cash. However, over that course of time, just reinvesting those dividends back into the growth is going to compound your portfolio at a much quicker pace. And by the way, I've been speaking about each one of the companies that we just looked over for well over a year. Now, of course, you might be thinking, well, yeah, hindsight is 2020, but in reality, it's really not, from the standpoint of that if you're investing in quality companies like those ones that are actually focusing on increasing their underlying financials over time, well, typically speaking, 9 times out of 10, the market share price is going to, at the very least, somewhat follow that growth in underlying business. And if the company is a dividend player and they actually value dividend distributions, well, they do have vested interest in keeping shareholders happy in continuing to pay out and raise those dividend distributions for the foreseeable future. So even though since March of last year, there's been massive capital expansion throughout a bunch of different industries, this is also the case for the companies we just looked over. And this really just comes back to the idea of dollar cost averaging each and every month into your highest conviction stocks and companies that are financially strong. I know this isn't necessarily the new investment flavor of the month and is somewhat repetitive, but this definitely has worked for me. Now, moving on, another easy dividend portfolio option that still remains viable is utilizing dividend-focused exchange-traded funds, and that's something that we've actually spoken about quite recently in the video that I'll overlay right here. By the way, if you haven't already checked that video out, make sure to do so. It's really thorough and goes over a bunch of different options, but for that reason, we won't necessarily dive into full detail in today's video. It is quite straightforward though. Essentially, instead of holding individual dividend stock positions, you would hold an exchange trade fund like this one that is focused on dividend income. And there are quite a few of these ETF options available and to choose from in both Canada and the United States. As mentioned earlier though, the reason why I tend to focus on individual dividend stocks when it comes to dividend investing is because I really do like to cherry pick the companies that I believe in most and think that their dividend distributions are well covered by earnings, as well as have the most potential for growth over time. Unlike other broad index funds like for example the S&P 500 or the Nasdaq 100 that I speak about all the time and that both hold companies I know absolutely nothing about, these indexes track a broad enough set of companies to diversify you in a way that is actually beneficial because they hold top companies across the United States. But often when it comes to a dividend ETF, they'll just hold a bunch of dividend stocks because, well, they're dividend stocks, not because they're actually quality players in their industry and that would actually make sense to hold in a dividend focused fund. For example, a bank focused ETF will typically have a higher yield, but that doesn't necessarily mean that I want to hold and have exposure to each one of these banks. The same thing would apply to say a dividend aristocrat ETF. Just because it's an aristocrat doesn't necessarily mean that it's a quality company and that the yield is attractive. What's more is that you will be paying a management expense ratio on a dividend focused ETF. And because typically these aren't as passive as some other options like an S&P 500 ETF, the management expense ratio, at least in Canada, will be at above 0.2%. In the US, you might be able to find much lower MERs, but in Canada, this type of ETF will generally come with a higher management expense ratio. But yeah, so the goal of today's video was really to highlight the fact that when first setting up a dividend portfolio, it doesn't need to be overly complicated. If you're looking for dividend ETFs, well, you can literally hold 1 or 2 of these potentially and then allocate the rest of your portfolio to assets and other ETFs that are going to fit within your desired asset allocation split that are suitable for your investor profile. And if you're looking for individual dividend stocks, utilizing some of the criteria that we spoke about is going to be a really nice preliminary way to do a stress test on these companies, and looking for 5 to 7 stocks is going to be adequate when you're first starting out. With that said, here are some things that you shouldn't necessarily be focusing on right away. So the first one would be looking for the highest yield exclusively for the reasons that we spoke about earlier. A global assessment is going to be the way to go for picking each individual stock. The next thing is not to include just too many stocks and clutter up your portfolio along with too many dividend stocks from the same industry. If you have 5 dividend stocks all in energy, well, the second that the energy industry has some sort of rotation, you could be left holding the bag or having dividends being cut across the board in your portfolio. Another thing not to focus on that I see a lot of beginner investors looking at more specifically is the frequency of dividend distributions. Typically, companies are going to pay out their distributions on a quarterly basis, meaning once every 3 months, so 4 payments per year. But the yield is going to be the exact same in terms of how much you're receiving for your holdings, whether or not the distribution frequency is quarterly or on a monthly basis. So I see a lot of people looking for monthly dividend stocks. Sure, it's nice to have monthly income coming coming in, but in the big picture, you're getting the same amount of money. And for an easy dividend portfolio, here are things that you do want to look for. The first thing is going to be a quality yield that actually makes sense in relation to the company's financials. Speaking of which, a dividend payout ratio at around 50% or less is going to be favorable, but depending on the company, up to around 60 can be tolerable. The next thing you want to focus on are companies that are consistently raising and paying out their dividend distributions over an extended period of time. Typically, minimum 10 years is what I favor. And finally, companies that are actually growing over time. And so for this reason, capital appreciation is also going to be part of the strategy here, hence dividend growth investing. So if you're new to dividend investing, I really hope that today's video helped you and helped simplify some of these concepts. If you're looking for more information about dividend growth investing, along with some quality dividend companies and an analysis about each one, then make sure to check out my dividend investing playlist on my channel. And if you want to take it a step further and learn everything you need to know about stock market investing, and then all the way up to setting up your own portfolio suitable for your needs as an investor, then make sure to check out my full 60 video lecture course that you can find down in the description. So on that note, thanks a lot for watching today's video, everyone. I hope you enjoyed it, and I will see you in the next one.